Hello and welcome to our special holiday look at investing in 2021. And we're going to shine the spotlight on Webjet and Elmo Software. And Adam Dawes from Shaw & Partners is going to look at a number of stocks he's interested in as well. Now, I like both Elmo and Webjet because they're stocks I think will benefit from the reopening of the economy. And as we know now, New South Wales is having a bit of a problem. Don't think they'll last all that long, and eventually the vaccine will kick in, and stocks that will really benefit as we head towards normalcy, they're the ones who will have a pretty good year. Webjet's one of them, I think. Elmo Software is another one. And I interviewed John Guzik from Webjet not all that long ago, and also Danny Leeson presented at our small cap conference, and Danny is the founder and CEO of Elmo Software. So let's kick off now and listen to how John Guzik thinks his company will do as the borders open and normalcy approaches.
It was very heartening. It was one of the things that we took away from the exercise, took away from the process, was that there were many people who knew the plight, and we hired bankers to go through and help us with extending the story to the investment community. And most people didn't want to see us fail. And obviously in the end, when we did complete the raising, it was substantially oversubscribed, and there were a sense of relief, but there was also from our side, but a sense from the investment community that it would have been a shame that Webjet, which had been a successful Australian business that had taken its wares offshore and been successful internationally, and I'll hark back to the 2019 results. 60% of our EBITDA was for a business that we started up only 6 years ago. So it was one where there was a sense of relief. There was a sense of expectation that we could continue our growth story once the pandemic had subsided, and there was great support across the broader investment community, and we've seen that continuously over the bond note that we raised in July in addition, and then the support and the feedback that we've had from our investors has been it would be almost overwhelming how positive they've been about the business over that journey.
Apart from the fact that it's a great joy of life for me to be able to talk to you, there is actually a monetary reason why I've got you here, and I want to ask a few questions on behalf of my beloved viewers that will actually help us understand where your company's going. First question: how important is the Australian domestic travel market to your bottom line? Give us some sort of percentage.
Sure. So we have three divisions, and one is the WebBeds B2B business, which accounts for about 60% of our profit. And we have the Webjet OTA business, which is impacted by the closure of international borders in Australia and the closure of domestic borders. The way our business is carved out in that in the OTA business, the brand that most of your viewers will know us by, the one that you see on TV and on billboards, etc., is that we have 85% of our volume is domestic bookings and 15% are international bookings. And by revenue and TTV, 65% is domestic and 35% is international. So in the current environment where domestic bookings are a fraction of what they used to be and international bookings are virtually non-existent, we're in a scenario where if we get to 23% of our previous volumes, we will be profitable in that division. At the moment, we're tracking at around about 16%, so we're sort of 2/3 of the way there. We're extremely optimistic that once one of the borders, either New South Wales to Queensland or New South Wales to Victoria, opens, that we get to at least break even, and when two of the borders open, we'll be profitable again. One of the things that is important for investors to note about our business since we last spoke is that the consequence of the pandemic has meant that we've taken a significant amount of costs out of our business, and therefore our break-even and profitability numbers are much lower than they used to be. So the scalability on the upside is quite considerable at this point in time.
Thanks, Peter. It's my pleasure to introduce your viewers to Elmo Software. Just a brief company overview. Elmo is a leading provider of cloud HR, payroll, rostering, and time and attendance software. And we have been operating mainly in Australia and New Zealand. We have a wide convergence solution, which provides our customers with an all-in-one platform to manage their people, process, and pay. We have one vendor, one dashboard, and one user experience. Just a few facts about the company. Currently, we have circa 430 employees, and they are spread across offices in Australia, New Zealand, and the United Kingdom. We have just under 1,700 customers, and it's a scalable SaaS cloud-based solution. Our total addressable market is about $11.4 billion. Just a little bit about Elmo's wide convergence suite. It consists of 15 modules, which can be sold separately or can be seamlessly integrated experience for our customers. And they span across pay, engage, hire, retain, and development. So we have a one-stop shop for our customers to be able to manage their people and processes throughout the entire employee life cycle. A little bit about our financials. We're a high-growth technology company. Over the last 3 years, we've had an average growth on an annual recurrent revenue basis of 33%. So high growth, there's been a great engagement by our customers, and we can see going into our FY20 pro forma ARR, we're at a revenue of $61.6 million. That includes our Breathe acquisition. Very importantly is the complexion of the revenue. We can see that in FY20, over 97% of our revenue is subscription in nature. That means it pyramids from year to year. If we look at the complexion of the annual recurrent revenue, we see about 60% of our ARR in FY20 comes from new customers, and about 40% comes from existing customers. And that comes through cross-selling our extensive suite of product. If we just look at our strong organic growth strategy, we focus on new customers in existing markets. So thus far, we only have 7% penetration of roughly 24,000 organizations in Australia and New Zealand. So we have lots of headroom to take on new customers. We also are getting greater usage from our existing customers. We have an average modules per customer of 2.7 out of a potential 15 modules. That means there's heaps of opportunity to continue to cross-sell our modules to existing customers. We also focus on expanding and enhancing our product line. We increase R&D investment to develop new modules, so have new revenue streams, and we also focus on enhancing the functionality and interoperability of our existing modules, so to improve the customer experience and to put them in a position where they purchase the next module. We supplement our high-growth organic strategy with a inorganic mergers and acquisition strategy. And we've really disciplined here, and we have a strong track record. We've executed eight acquisitions since 2016. And I might just talk to our latest acquisition. That is an HR platform which is fit for purpose for small businesses, which is based in the United Kingdom. Now, a very, very high growth, well-recognized platform. It was founded in 2012. Currently, its annual recurrent revenue is at $6.5 million, and that is 100% subscription. And it's had historically high growth in over 30% on an ARR basis. Currently, there's 6,700 customers. They are all based in the UK, and we have a very high retention rate of around about 85%. The company itself is just under 50 employees. Now, the big opportunity with Breathe is it gives us the scope to expand our market opportunity by having a fit-for-purpose platform for small businesses. And we will be standing this up in Australia and New Zealand in round about Q4 of this financial year. Another area of revenue extraction is we'll be able to add on additional modules onto this platform. So currently, the customers only pay for one module, but we have heaps of other functionality which we'll be able to sell on a modular basis, both in the UK and in ANZ. So we're really looking forward to continue with our growth journey. Over to you, Peter.
Hi, I'm Peter Switzer, founder of the Switzer Report. And if you're looking to build your wealth, my Switzer Report has everything you need. And so I'm inviting you to come and invest in stocks with me. At the Switzer Report, we provide you with expert guidance and actionable advice for managing and growing your wealth from some of the brightest stock pickers and investing minds in the country. And so I've got some great news. For the next 2 months, we have a fantastic Christmas and New Year offer that I would like to tell you about. If you take up a Switzer Report subscription across the months of December and January, not only will you get all the usual inclusions to the report, but you also will get the following. Exclusive one-off webinar with myself and Paul Rickard, where we will show you the hot stocks we picked in 2020, and we'll also give you the stocks we are picking for 2021. You'll receive a free copy of my book, Join the Rich Club, valued at $24.95. And you'll also receive a free ebook with our best investment ideas for 2021. Sign up today and receive 3 newsletters each week delivered direct to your inbox on Mondays, Thursdays and Saturdays with analysis from our experts including myself, Paul Rickard, Tony Featherston and James Dunn, and others such as Julia Lee, Junbei Liu and Rudy Philippek van Dyke. Your questions can be answered in the Q&A forum where you can submit an investing question and receive a guaranteed response from Paul Rickard. Monthly webinars with myself and Paul Rickard and special guests who will answer your questions live. You receive complimentary tickets to our events for you and a guest, including our annual Switzer Income Conference, the Switzer Investment Strategy Day, the Switzer Listed Investment Conference and the Switzer Small and Micro Cap Investor Day. You'll also have access to our weekly Boom Doom Zoom interactive TV webinar, which are stock assessing sessions between Paul, myself and subscribers. You'll be able to view our income and growth model portfolios designed and updated each month by Paul Rickard, and you can browse the archives containing thousands of archives and resources about specific shares, the markets, SMSFs and more. Information and insights from people who live and breathe stocks 24/7 increases your chances of making some real money on the market. I really want to share with you all the insights I get access to that most investors are never lucky enough to see or hear. Come invest with me using my Switzer Report. Follow the link in the description of this episode or visit www.switzerreport.com.au to sign up for your Christmas New Year offer and join me on the journey of financial knowledge and wealth, where I will be able to call you one of my valued Switzer Report subscribers. And that was Danny Lewsom of Elmo Software. And now let's catch up with Adam Dawes with his look at a number of stocks that I threw to him that he likes, and some of them he's not all that keen on. Well, Adam, another day when the market's gone up. Do you think this market's going to keep on rising into 2021?
Yeah, I don't know. To be honest, it's looking like we've had our Santa rally. November was a fantastic month for our market. I sort of struggle to see how we will continue to keep this momentum moving. However, I will say commodity prices are moving higher, which means earnings per share will move higher, which means our commodity stocks will move higher. And so potentially we will hold this 6,600, 6,800 until Christmas.
Yep. Okay. Let's look at the stocks I asked you to have a look at. And these are stocks that people are asking me about all the time. So let's start with Catapult Group International. What do you think?
So going through COVID, this thing potentially was going to be very, very tough. Basically, no one's playing any sport, so these guys were going to struggle. I think what they've done is they've done very well in lowering costs. They've got a strong balance sheet, and they can illustrate some resilience. However, I think 2021 is going to be a tough year for them. I think this is a 2022 story. I still like it, but the return to growth will definitely come in 2022. So this one is probably a hold from me. I'd probably sit back and watch this one over the next 6 months to a year, see how they go. They do have a good balance sheet, but yeah, I think they will struggle as things come back to normal. But definitely 2022, it's a buy.
Okay, let's go to PushPay now.
Yeah, PushPay. Again, this is one that actually surprised a lot of people through COVID because obviously it's a payment system that looks after software for churches and those kinds of things, and customer donations and things like that. I think this one is a hold again for me. It has come under some selling pressure over the last coming couple of days and even over the last month, moving sideways. I think PushPay will be able to build that community of churches, especially in the US, and continue. But there's more things that these guys can do. It's not just churches. It's so many other things that are getting donations. So I'm quite positive on this one. The stock definitely looks like it's in a sideways pattern. So just be a little bit careful here. And I'd like to see some upgrades from the company before I'd start to buy in to these ones.
Yeah, you can imagine football teams and those community groups could easily get into using the services of PushPay because they're always looking for money and people are interested in supporting them, but it becomes a little bit too hard sometimes.
I agree. And look, technology is moving forward at such a rapid pace that these things will do well. And it's certainly, the clip of the ticket is where they're making the cash. So, yeah, it's an interesting one. I like the story, though.
Okay, what about Appen?
Yeah, look, one of our favourites really in the tech space and has done very well. I mean, there's a lot of companies or a lot of research houses that are upgrading these guys at the moment to outperform or even a sector perform. The US technology customers sort of seems to be rebounding at the moment, and advertising revenue seems to be moving through as well. I expect that their results are going to see a re-acceleration of search advertising and revenue, and they've got their largest customers being Facebook, Microsoft, Google, Amazon, all of these kinds of things, which represents around about 80% of their revenue. So I don't think that's going away. I think it's a buy. I'm always happy to buy this on weakness. A lot of analysts have sort of upgraded their targets and increased their price target. I'd like to see this around $40 before I'd even potentially put a hold on it. So I think, yeah, this one's a screamer and it looks good.
Double Corp.
Well, you're getting the hard ones to me today, Peter. Definitely. Dubber, look, I saw this at 20 cents and didn't really like it. Maybe because I didn't understand the business, and that's probably my fault for not understanding it. But Dubber's a fantastic business because certainly when you ring a telco and then you ask for your recording back because potentially there's been an issue, it can take up to 7 weeks to get that recording back. Dubber is a business that has that technology solution that's a scaled, cloud-based call recording system that can basically get that back within 5 hours or even 3 hours. You can get that recording back straight away. They've had some really good contract wins with Telstra, and then they've got some fantastic business with AT&T, Cisco, IBM, and those kinds of things. They do a service as a software package. So every time they add a new customer on, it's just pure profit. I think it's a buy, and it's a really good story. We like it here at Shores, and we've got a buy on it as well.
Okay, let's go finally to Megaport. Had a good day today. And I should say to you, after you, I'm actually showing an interview I did with Bevan Slattery, who probably knows a little bit more about Megaport than you. But what are the brokers?
Okay. I'll take that.
So what are the brokers saying?
Oh, look, Megaport's a fantastic business, and it has come under it has been sort of moving sideways, and the pattern has been moving sideways. But I really like this business. Bevan Slattery, obviously one of the major founders of this business, and has done very, very, very well out of it. But the whole idea of connecting people to the cloud in the old days could take up to 3 months. Megaport can do it in 30 seconds. So that's their competitive advantage. And I suspect that they will continue to do that. We really like it. I like it at $14, $15, $16. I think it's a buy. They certainly will accelerate that business going forward into 2021. So yeah, I can't say enough good things about it, about that one, Peter.
Okay, well, I'm glad I picked out some stellar stocks for you to comment about.
It's always the hard ones when you're on a Monday afternoon, that's for sure.
Adam Dawes, thanks for joining us, mate.
Thank you. Have a great day.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.